Hi, I'm Stacy Burke from Stacy Burke Trading. Would you like to know the money management secrets for traders that separate surviving and making big profits? Stay tuned, we'll be right back. Hi traders, money management is the difference between surviving and generating big profits. If you can understand this one basic simple concept, it will be the first major step in the right direction to becoming consistent and profitable over the long term with your trading. Now basically there are two core concepts with money management. The first one is about survival, or avoiding the risk of ruin or blowing yourself up and destroying your trading account. And the second part is about profits and the generation of a geometric profit pyramid. And that simply comes down to two areas where if you can get those in place and you have a positive trading expectancy, the money management is the secret that can take your account from a break-even or a losing situation to one that's generating profits and possibly on a large scale. Now this is just a basic model, and certainly there are personal levels of comfort in terms of what you're prepared to risk and how your trading style is that you can tweak and do on your own, but it's of great certainty that you have a money management strategy in place to avoid the risk of ruin of your trading account. So basically, if the two simple premises are that if you're losing money, reduce the exposure of your trading size. If you're making money, increase your exposure so that you can geometrically profit from that. So the first part of the risk management component is about planning your risk. Now this isn't about your trading plan. This is about creating some consistency in your losses or in your exposure. So this is where we want to try and determine our comfort level based on how we're trading. Now a really simple way to approach this is possibly suggesting that we're going to risk 1% of our account size as a maximum amount of exposure on every single trade. And what that's designed to do is create consistency for us knowing what our maximum amount of account drawdown is for each individual trade, if indeed they're losers. Now, if we can create that, what that means is that we know there's only a set amount of capital each time, and if the account is shrinking, we know that that percentage size is still the same, and that will ensure that even if we have a patch of losing trades, that our losses are scaling down as we're losing money. Our losses are smaller because it's only a percentage of our account size. And that's, again, designed to ensure our survival or not having risk of ruin. Second part is stop loss. Now this is where, in your technical aspect of the trading part, you want to take a place on your trade where, based on your analysis, it invalidates that initial premise as to why you had a signal to enter the market. So where that trade would be invalidated is where you would place your technical stop loss. And we won't talk about position sizing, we'll get to that in a later video, but the stop loss is going to ensure the maximum of the 1%. So if you have a point, you're going long in the market, your maximum stop loss, where that stop loss on the chart is going to be no greater than 1% based on that technical stop. So again, your account size, whether it's growing or shrinking, it's always a reflection financially of that 1%, but also on the chart. We had a situation earlier last year where the Swiss government intervened and unpegged the currency pair, and several traders had catastrophic losses, and also a few of the brokers, because there was a gap that occurred in the market from where it had closed at to where it opened at, and several traders had a gap, and the market didn't actually trade through their stop, and those stops were triggered upon the opening of the next morning. That's an event that could happen, but in most cases You want to always have your stop loss in place that will guarantee any type of catastrophic activity going against you will still only hit that 1% loss. The third part of that is diversification. And what that allows us to do, especially, for example, if you're trading in the currency markets or the Forex markets, is that even though you might be trading different pairs, there may be correlation there where you're actually doubling up on your exposure on those different trades. And the example that I've just jotted down here is if you went long on the the Euro US dollar, and at the same time you shorted the US Swiss franc. Technically those are very correlated pairs, and you effectively, if that was a losing trade, could have just doubled your loss, because they'll probably move in the same direction. So for example, if you were long the euro, short the US, you shorted the US to the Swiss, you're basically taking a short trade on the US dollar in both directions. So one way that you could look at doing that is make sure that you're either trading different markets. For example, you might be trading the pound yen and the CAD chief. They're definitely not as correlated, but you might trade the pound yen and you might be trading oil, or you may be trading an index and one of the currency pairs. Again, you should look at the correlation of the different instruments and make sure that you're not doubling up on your exposure when you're taking those trades. The other side of the coin with that is about your profits and generating geometric profits. When we talk about expected performance and your equity curve, if your equity curve is nice and stable, that means you've got a fairly consistent model happening with your trading system. It's performing as expected and you're generating a profit based on the edge that system extrapolates. Then you may look at possibly having a greater exposure in the market. And again, this is just an example. You'll need to refine that based on your own levels of comfort for risk and your account size. If you have multiple trades on at one time, you may not have that much exposure. And you'll find that usually with a fairly stable equity curve, that there's a basket of instruments that you can trade up to a certain amount. You have to determine at what point you're comfortable. So as long as that you're getting a positive expectancy and the system's performing as it should, you might want to be trading at that higher end of the equity curve in your exposure. If your performance hasn't been as stable and you're not confident that your methodology is going to perform that well in the next certain allotted time frame, maybe the markets are more volatile or there's been other unexpected events occur, but you're not confident that the system is going to be performing as well, you might reduce your exposure and take it down again 1% or 0.5%, depending on your account size and the level of comfort for your risk. If you've got your system performing reasonably well, the equity curve is mildly stable, so it's a balance where you've got a balance of your profits and preservation of capital occurring, you might go somewhere in between. And again, you need to monitor that, and if you're doing that manually, you might do that in blocks of 10 trades at a time. For a beginning trader, what I would suggest is to keep that exposure fairly low, keep it consistent until you know that you've got your expectancy, a positive expectancy with your trading system. Ultimately, everything boils back down to your trade expectancy, and it must be positive. If you're not running a positive expectancy with your methodology, the money management won't matter. But if you've got a positive expectancy happening with your trading, the money management is the one key secret that can separate survival from generating big profits. So go back, check your strategies, make sure that you're sticking to your risk management. That is the one key concept that you must get out of this. One of the biggest reasons most traders fail is that they don't have a money management strategy. And often what you'll find in the leveraged market is that they will take massive losses and small successive gains in one big trade. They'll take a massive loss. They'll either not have a stop loss in place, they'll have taken way too much leverage on for their account size. They'll get into a situation where they'll be irrational and not be using their trading plan, and they'll let that loss possibly run to the point where of maximum pain, at which point they can't stand it any longer. They'll close the trade out with a catastrophic loss and possibly have crippled their account or destroyed it entirely. So stick to your money management. Hopefully you got some value out of today's video. Watch this over and over again. Get your money management concepts straight. Stick to the trading plan. Hi traders, it's Stacy Burke from Stacy Burke Trading. If you haven't done so, please head over to my website at stacyburketrading.com. I create updates on almost a daily basis and I would love for you to receive them. Just click on the blog. If you want to enter your name and your email address, I'll send you my free audio program, the 7-Step Daily Routine for High Performance Traders. This is essential knowledge for all traders in all markets, and this is for helping traders to master the market with discipline, confidence, and a winning mindset. I appreciate all your feedback and comments. As always, traders, stay disciplined and may the markets go with you.